Anyone who believes in indefinite growth on a physically finite planet is either mad or an economist.
We don't want to focus politics on a notion that involves the rejection of principles around which a large majority of our fellow citizens organize their lives.
We are not as endlessly manipulable and as predictable as you would think.
We're living in the middle of what I would describe as a pandemic of banking crises around the world for the past 35 years or so. Only about 29% of countries around the world have managed to avoid a major banking crisis during that time, and some have had more than one. The United States, for example, has had two major crises during that period. I want to emphasize that that's quite unusual. So why are these banking crises happening? The standard view among economists is two things. First, banks are inherently fragile. They hold on their asset side opaque assets, assets that can be hard for outsiders to value, and they finance those assets acquisition with short-term liabilities. And if there is a big shock that happens, that big shock that can raise questions about the value of those assets leads people to be concerned that banks might not be able to meet their payments. They might withdraw the debts from the banks. In anticipation of that, the banks themselves might decide to stop lending and start trying to accumulate cash. So you get the picture. Now, the problem with this is that it's not going to be a sufficient answer to the question. And the reason it isn't a sufficient answer is because the frequency of banking crises differs across time and across space. And in fact, we're currently living through a pandemic of banking crises. But other times, let's take, for example, the period 1874 to 1913 is one in which the inherent sort of volatility of the GDP in the world was actually greater than it is today. And yet, during that time, we had very few banking crises. So it can't really be that big shocks combined with the inherent nature of banks explain crises, because they're so much more common today. Furthermore, some countries, even when they experience very big shocks, and even though they may have very lively banking systems, that is, banking systems that are providing a very large amount of credit, may be able to avoid crises, while others that are providing similar amounts of credit, or maybe even less amounts of credit on average over time, might experience much more. And the comparison that I've got here to describe today is between Canada and the United States. So Canada is a country that experienced zero banking crises from the beginning of the origins of its banking system till today. The U.S. has experienced 17. Yet the Canadian banking systems actually produced more credit on average relative to GDP than the U.S. has during that period. Canada, of course, is a primary commodity exporting economy, and its GDP has been much more volatile over time than the U.S. So what's the other missing element in the story that can explain this frequency and severity of banking crises in some countries relative to others? Is it regulation? And I would say yes. There's a lot of economic evidence that different countries and at different times, the same country, changes in regulation have mattered a lot for making the banking system relatively fragile. The most important regulatory change has been the tendency to protect banks. The more banks are protected with deposit insurance or other kinds of bailout policies, the more they seem to get into trouble. If you're protected, then you feel that you can take a little bit more risk. And it's the combination of protection with inadequate prudential regulations. When those two things are combined, they do seem to account for some of the difference over time and across countries that's observed. But then that just begs another question, which is, well, why do some countries seem to consistently combine protection with inadequate regulation, while other countries seem to be able to avoid the problem? And so our answer is that if you're looking for the reason behind regulatory differences in countries, you have to look at the politics. That's where regulation comes from. When the political environment is such that it's easy for political groups to form, coalitions of different people to form, to find a way to use the banking system regulation as a means to channel resources from some groups in the population to others. That is, some factions find a way to make the banking system favor them at the expense of others. That seems to be the sort of underlying common denominator of banking systems that are dysfunctional. That is, both that tend to provide less credit and tend to be more unstable. Banking systems can be particularly attractive as these kinds of tax and transfer devices because it can often be very hard for people to see exactly how, unlike on-budget government expenditure, it can be very hard to see exactly who's being favored and who's being taxed. That is, who's being disadvantaged and who's being advantaged by the system. We call the political process of bargaining and these formations of coalitions that control banking system outcomes, we call that the game of bank bargains. Now, the way that game is played varies, of course, across different countries, especially it's very different within democracies than it is within autocracies. But that's, no matter how different the game is played, that's the common denominator of problems. What about credit scarcity? The strange thing is that even though the basics of commercial banking were all in place by the middle of the 18th century, most of which having been invented in Scotland prior to that time, and I think we would agree that they're not rocket science, nevertheless, most countries in the world still have not managed to imitate that. That is, we still are in a world characterized by scarce credit, by a scarcity of basic commercial banking practice. And we point out that that deficiency in banking is explained similarly by political factors. So that this gives you a little bit of a sense of the ratio of private credit to GDP and how much it varies across countries. But you can see the enormous variation in the ratio of credit to GDP with a country like the UK at about 1.5 times GDP in private credit, whereas a country like the Democratic Republic of the Congo with essentially zero credit relative to GDP. Now, some of you laughed and you probably thought, well, they're not surprised that countries that are so war-torn and having extreme governance problems are going to have a hard time constructing a banking system, and I think that's exactly right. But the thing is that one has to generalize a bit from that and understand that it's more generally the case that political problems or political deficiencies are at the very heart of banking system problems and banking system deficiencies. We take very seriously the idea that banking system design reflects implicit partnerships between governments and private actors. And we take very